For my new subscribers, I do videos every single day. I usually do 3. And if you look at the bottom of your screen where it says the description box of the YouTube video, you will see I have a link there titled Today's Playlist. If you click that link, it will bring up all 3 of my videos and they will play one after the other to make life easier for you. Well, it's your pal, your buddy, JSNIP4. So we had the Federal Reserve raise the rates, 0.25%. And we think we're going to do it again and again and again, 3 to possibly 4 times this year, which we've just done 1. Not to mention, it was just December where we did 1. And I went today, I'll do it right now just to double check, mortgage rates. And got Quicken Loans, we got bank rate. Let's go to Quicken Loans. And 30-year is 4.2 basically, and of course APR is 4.45, the one that matters. So keeping in mind we were just in the 3s, then it was 4.1, now it's 4.2, then again actual APR is 4.45 or 4.5. If we do another couple of rate hikes, which the Fed's saying they are, and probably a third one now that we've done 1 to make a total of 4, that would be 0.75% plus the one we just did. We'll have a full percent higher. Again, it's not great for the economy. Having said that, Janet Yellen, of course, in her speech, and basically she said all of our data that we look at as the Fed, which is basically crap, we're going to raise. We're going to go ahead and raise, and we're going to keep raising the rest of the year. It looks like we're going to, and markets really didn't care one way or the other. Gold and silver. Matter of fact, well, I take it back. Markets did rally in the beginning. Dow Jones Industrial Average. What do we have today? Yep, they ended 112 points up. Gold and silver, however, especially silver, was up like 44 cents, I think, at one point. And I think when I last looked when I got home, which is basically the end of the day, it was up 44 cents. They liked it. However, higher interest rates with an absolutely horrible GDP should normally not go together hand in hand. So there's 2 things I want to talk about. One's from Wolf Street, one's from Zero Hedge. Bond carnage hits mortgage rates, aims at housing bubble 2, 2.0. But as Zero Hedge has, and this is great, because somebody got to ask Miss Janet Yellen a question, such as, I'm going to read this to you because it's fantastic, such as, why did you raise rates when GDP is worse than terrible? Let's hear what she has to say. Startled reporter, this is Zero Hedge, asks why Yellen hiked with GDP and real wages sliding. Here is her response. Today's FOMC press conference was the standard affair. Reporters ask broad questions. Yellen responds with even broader comments that amble aimlessly, leaving no one any wiser as to the Fed's true intent. That is until Bloomberg TV's Kathleen Hayes decided enough was enough and wanted to get to the bottom of just why a data-dependent Fed is hiking in a world in which economic data is rapidly deteriorating. The bespectacled Hayes dared to suggest some facts in real news, as opposed to Yellen's forecasts, in an effort to comprehend what changed in March to turn a ubiquitously dovish Fed into a seemingly panic-stricken pack of hawks. I'm going to try to take the opposite side of this because in this question about market expectations and how the markets got things wrong, and then how you say the Fed suddenly clarified what it already said. But for example, if you look at the Atlanta Fed's latest GDP tracker for the first quarter, it's down to 0.9%, We had a retail sales report that was mixed. We had the upper divisions of previous months make it look better, but the consumer does not appear to be roaring in the first quarter, kind of underscoring the wait and see attitude you just mentioned. If you look at measured of labor compensation, you note in the statement they are not moving up, and in fact they are. And if you look at average out, there are so many things you can look at, and you yourself have said in the past that the fact that this is happening is perhaps an indication that there's still slack in the labor market. I guess my question is this: in another sense, what happened between December and March? GDP is tracking very low. Measures of labor compensation are not threatening to boost inflation anytime fast. The consumer is not picking up very much. Fiscal policy, we don't know what's going to happen with Donald Trump, and yet you have to raise rates now? So what is the motivation here? The economy is so far from your forecast in terms of GDP. Why does the Fed have to move now? What does this signal then what about rest of the year? And Yellen frowned awkwardly and began to say, so GDP is a pretty noisy indicator. And then she said, if one averages through several quarters, I would describe our economy as one that has been growing around 2% per year. And as you can see from our projections, that's something we expect to continue over the next couple of years. Now that the pace of growth has been consistent with a pace of job creation that is more rapid than what is sustainable if labor force participation begins to move down, in line with what we see as its longer run trend with an aging population. Now, unemployment hasn't moved that much, in part because people have been drawn into the labor force. Labor force participation, as I mentioned in my remarks, has been about flat over the last 3 years. So in that sense, the economy has shown over the last several years that it may have had more room to run than some people might have estimated, and that's been good. It's meant we've had a great deal of job creation over these years, and there could be room for that to play out further. In fact, look, policy remains accommodative. We expect further improvement in the labor market. We expect the unemployment rate to move down further and to stay down for the next several years. So we do expect that the path of policy we think is appropriate is one that is going to lead to some further strengthening in the labor market. So not one comment on the actual data points that Hayes refers to. Merely the standard result to something about employment comment and end on a reassuring tone of accommodation remains. But Hayes was not done, and unlike the rest of the room, would not take Yellen's wishy-washy bullcrap response as writ. Just quickly then, I just want to underscore, I want to ask you, so following on that, you expect it to move. But what if it doesn't? What if GDP doesn't pick up? What if you don't see wage measures rising? What if you don't, what if something gets stuck at 1.7%? It says inaudible. What if the blank gets stuck at 1.7%? I'm assuming that you might have meant GDP, even though it's 0.9, the latest. Would you? Is it your view, perhaps, that if there's a risk right now in the median forecast for dots, pH, whatever that is, that it's fewer hikes this year rather than the consensus of more hikes? To which an anxious Janet Yellen replied, notably eyeballing off camera to somebody, clearly upset at being cornered on some facts. Well, look, our policy is not set in stone. It is data dependent, and we're not locked into any particular policy path. As you said, the data have not notably strengthened. There's noise always in the data from quarter to quarter, but we haven't changed our view of the outlook. We think we're on the same path. We haven't boosted the outlook, projected faster growth. We think we're moving along the same course we've been on, but It is one that involves gradual tightening in the labor market. I would describe some measures of wage growth as having moved up. Some measures haven't moved up, but there is also suggestive of a strengthening labor market. And we expect policy to remain accommodative now for some time. So we're talking about a gradual path of removing policy accommodation as the economy makes progress moving toward neutral. But we're continuing to provide accommodation to the economy that's allowing it to grow at an above trend pace that's consistent with further improvement in the labor market. So when faced with factual data points, such as real wage declines, collapsing, let me repeat that one, collapsing GDP growth expectations, disappointing retail sales, and I'll add the retail apocalypse of store closings, continuing, and uncertain fiscal policy, the chair of the Federal Reserve defends the decision to rate hikes for the third time in 11 years by saying that data is noisy. It's noisy data. That the Fed's forecast for growth remains positive and that the Fed remains accommodative. For now, it seems what matters to the Fed is not hard, real economic data, but soft, surveying, confidence data, or, as I like to say, hopium type of data. As a reminder, this may be the weakest quarter of economic growth rate. Let me try that again. As a reminder, this may be the weakest quarter of economic growth for a rate hike since 1980. Sadly, we suspect Ms. Hayes' future question-asking privileges to ask, Ms. Yellen questions will go the way of the Wall Street Journal's Pedro da Costa. In other words, you ain't coming back again. You will never ask us a normal question that the rest of the United States citizens want to hear answers to. You will never ask those questions. We only allow softball, nonsensical questions, which is why she looked over like, who is this person asking me this? I thought you vetted everybody in here. Let me pull some mumbo jumbo out. I could have done this. I could have shook this magic 8-ball and just read things off of it. Well, with the GDP, it's really cannot predict now. Just with the GDP. As far as the labor market's concerned, or at least what your concerns are, we're very, very doubtful. As far as a rate hike continuing for the rest of the year, without a doubt. And I think next year I'm going to concentrate and ask again. I want you to concentrate and ask again. Matter of fact, I don't want you to concentrate. I want the next person to concentrate and ask again because you were busting my balls. If she had any. She might because she looked kind of, trans, not sure about her. Not really, but anyways, you get the point. So now let's talk about bond carnage. Hits mortgage rates. Federal Reserve had to raise those rates, right? Aims at housing bubble too. Many fear the Fed is behind the curve. The market is even further behind. This is clearly a dangerous situation. This is Wolf Richter. U.S. government debt took another beating today. And as prices fell, yields rose to multi-year highs. The 10-year Treasury yield rose 5 points, to 2.625, the highest since September 2014 when it just briefly kissed that level. At this pace, the yield will soon double from the record low of 1.36 in July of last year. When yields were surging maniacally in November, December, broadly called the bond massacre or the bond meltdown or similar, I pontificated that eventually yields would fall back some on the theory that nothing goes to hell in a straight line. And they did start falling back in mid-December. But that 3-month breather has now been totally undone. 2-year Treasuries took it on the chin too today, and the yield jumped to 1.40% or 1.4%, the highest since June 2009. And wasn't 08 and 09, pretty bad situation? Yeah, in this country and the world? Yeah, it was actually. The 30-year yield rose to 3.2%, the highest since July 2015. When yields rise, bonds with long maturities lose the most value. The 30-year Treasury bond price index has plunged 14% since early October, just last October, hence the bond massacre. He talks about mortgage rates. Mortgage rates have risen every trading day but one since February 27th. Today, the 30-year fixed rate, according to Mortgage News Daily, is easily up to 4.375% on top-tier scenarios, with a growing number of lenders moving up to 4.5%. That's the biggest rate or highest rate since April 2014, and it's up over a full percentage point from the 3.34% low quoted last July. So for the median home price in the U.S. at $228,900, a full percentage point increase to 4.4% would raise mortgage payments by $1,560 a year, again, per year, which on something like that, just going to guesstimate it for Florida, $228,000 house. What you got, PMI, insurance, taxes, all escrowed in, whatever. You're talking $100-something a month, most likely, just for that little change, just from a full percentage point, somewhere around there, anyways. It would raise mortgage payments by $8,256 per year. For a condo near the median price in San Francisco, it would raise mortgage payments by $8,256 a year. So, let me ask you a question. When you get a raise, and I'm talking your normal yearly thing, and some of you are saying, what are you talking about? I haven't had a raise in such and such years. I know. But those who have. Do you expect an $8,000 a year raise? Is that a legitimate expectation? So next year, we just hit 2017. This year you got an $8,256 raise. We're going to round that down to $8,000. Next year, another $8,000. Third year, $8,000. Fourth year, $8,000. 8 times 4 is $32,000. Do you really think you, wherever you may be, will be making $32,000 more dollars in 4 years, and that's normal, like for raises? Or is that absurd? That's absurd. Why I'm going here is because just by the interest rates changing, your realistic raise of $1,000 to $2,000 a year, etc., isn't gonna, can't hold a candle to the wind of this, because this just cost you $8,000+ more per year just by the rate going up. So again, I got another question. If 2018 comes around and they do another 3 or 4 rate hike scenario, we could be up 2 percentage points. We can go from 4.5 to 5.5. And remember what the rates were in 2003-4 time frame. Around 6%, 6.5%. Because again, 6, but then you look, APR 6.5, whatever, 6.5%. So imagine when we get to that level, 6.5%. Thinking back, when we had it good, boy, it was 3.5%. That's 3 additional percentage points, which will take many people's mortgages hundreds of dollars higher. No other reason but the interest rate. And I will say, God help you if you have anything in a adjustable rate. You got a home equity line, HELOC. You got your mortgage, first mortgage, second mortgage, HELOC, whatever. You have anything that's, tens of thousands of dollars or more. You're going to be in a little bit of pain. Mortgage Crisis 2.0 is coming near you soon, because what happened after 2008-9? Did they stop the adjustable rate mortgage thing? No. ARM mortgages more than 2008 and 2000. I'm just going to try to search if I can get. Why is the market share? Oh, that's 2010. Nope. Lest we forget, we had a financial crisis. This is from 2011. This is old. Freddie Mac, 2009. Come on, let me pause this because I really want to find this out. I want to see where we went from adjustable rate mortgages back in those days, which they all blamed. Remember they blamed it all over the news? It was adjustable rate mortgages. Let's see. Stand by for 1 second. Okay, I may have found a tiny bit of good news. In 2005, adjustable rate mortgages commanded 38.5% of the mortgage market, according to an analysis by the Federal Reserve Bank of New York. A decade later, Ellie Mae reports that adjustable rate mortgages account for only 5.3% of all mortgages originated during September of 2015. Stand by. Anyways, that's all I want to talk about. Got to take the call. See ya.